and why it's what it is today. All right, so on the left, we have a bullish balanced price range. And what I want you to think about is the market has to have some reason to want to turn down here. Now, it could be some kind of a discount array like a fair value gap or a bullish order block, or it's trading below an old low and takes sell side out before it rallies while you're in a market it's predisposed to go higher, in other words, it's already bullish. Then you have this gap here, and you have this gap here. Now, I purposely drew this out because I want to give you the internal dialogue of what I would expect to see on this candle here. A wick or tail would trade down into this partially, this range here, this little area here between this candle's low and this candle's high, and this candle's high and this candle's low. There's a balanced price range. They don't have to be identical. That's not one of the hallmarks to this. What this actually is, and it's a byproduct of markets becoming electronic, okay, and or 24 hours. In the old days, when I began trading, I was in the futures market, and I mentioned this the other day. These markets had sessions where they would open and close, and then there would be no trading. And the next day, wherever they opened up was like the lottery. Who knows where it was going to be? And it would create gaps. And if you could use a little bit of your imagination here, imagine this candle here not even being there. And then imagine this candle here not being there as well. So you'd have 3 candles down here with a gap between this candle's high and this candle's low, and a gap between this candle's low and this candle's high. So this candle doesn't exist and this candle doesn't exist. What you would end up with is a market that's declining, then a gap where no price trading was offered, and then 3 candles down here all by themselves, isolated, then a gap in here, no candle, and then the lowest of this candle would be here. So there would be missing data in this area here. What that actually is, and what it's transitioned into, is a old classic chart pattern. It's a reversal pattern called an island reversal. Okay, now I already know some of you in here, they're very cynical, okay, and you're running around with people that are just nuts, and they're making up things about me, and they're terrible, and they're not even true, and they like to make up nonsense about me. And I know you're in here, okay, but I want you to understand, I'm not renaming the island reversal because it becomes a balanced price range when there is market hours available. Okay, so it becomes a balanced price range because it's doing the very thing that if it wasn't trading electronically or with 24-hour trading, you would have actual gaps here. Okay, and I'll take you into Google and show you what an island reversal looks like. But once you see it, you'll say, oh, it makes sense, I understand now. But the logic has to be hinged on the fact that this is likely to turn and go higher anyway. Because without that, there's really nothing to associate a balanced price range on. Then it becomes like a fair value gap or institutional order flow entry drill. Okay, so this is the delineation between those other 2 arrays, which is, again, institutional order flow entry drill or fair value gap. Fair value gap is subdivided into BISI or SIBI, but balanced price range is hinged on the logic that if it's a bullish balanced price range, there has to be some logic as to why it turned here. And then you would visually see this as an island reversal where candles would be isolated after. In other words, it's dropping lower, then it gaps down in severe like capitulation, where the market just pukes up its guts. I apologize for that, but that's essentially what it's done. And it goes down there and it spends a few candles, and then all of a sudden there's some remorse to that, and it gaps up over here. So that would create a gap here and a gap here. Very valid turning point. Okay, it really communicates that there's some bullishness there. So if you trade down into this, it tends not to fill. So it creates many times the support structure behind an institutional order flow entry drill that would be bullish, and leaving that gap open, which we would like to see become what? A breakaway gap. So how all these things dovetail together. Now, everything I just gave you here for the bullish balanced price range is obviously reversed for a bearish balanced price range. The logic is there has to be some kind of reason to expect it to be turning lower up here, some kind of premium array. Bearish order block, old high it runs through. When you're bearish, you're looking for a run on stops. And then you have this area here, between this candle's high and this candle's low, that little area right there, matched up with over here with a candle low and candle high, that range in between with this area here, that's the balanced price range. So again, with this island reversal idea, which is an old classic chart pattern, but nobody really talks about it anymore because it doesn't form. I mean, it can form on stocks, but it doesn't form on like Forex because there's always trading. Like it's always trading 24 hours a day. So it won't create these gaps where it creates just a small little pocket or collection of like 3 candles. It doesn't necessarily mean 3 candles always. It could be really, 5 or 6 or 10, depending upon what it's done, that led to the gapping up there, and it holds it for a little while, and then all of a sudden it gaps down here. So you would have the trading at this candle here that closes, and these candles don't have to be up or down. It's just the logic is the balanced price range here when it's bearish. Okay, and then you would take these candles out internally when you look at price, and I would see this as an island reversal that's bearish. So any wick that goes up on this candle here that trades into this balanced price range, it should be kept at bay and not allow it to trade too much into this range, because it's already shown a willingness to discount this whole business here and say, okay, this is overdone. Let's get back to fair value as quick as we possibly can. Not fair value in the sense of the PD array, but fair value in terms of valuation for whatever that asset class is. Okay, so let me go over to Google and I'll show you what this pattern